So in the interest of time, let me move to the next session, which is going to be on AI and asset management. This session is going to be chaired by Sandrine Hadrys. Sandrine, welcome. Sandrine is Managing Director and Head of Europe for UTI International. She's leading the development of UTI International in Europe from Paris. Sandrine has quite some substantial experience, and she has been with UTI International for the past 7 years. So we're running 10 minutes late. Hopefully we will catch up. So Sandrine, the floor is yours. Thank you.
Thank you, George, for the introduction. Yes, so for this next session on artificial intelligence in asset management, I am pleased to introduce 3 distinguished speakers who will share their expertise with us. I am pleased to introduce Peter Hafez as our first speaker. So Mr. Hafez is Chief Data Scientist and a member of the executive team at RavenPack, where he has been at the forefront of applied new analytics since 2008. He has more than 20 years of experience in quantitative finance and is a recognized speaker on alternative data and artificial intelligence. He regularly presents at prominent conferences and leading academic institutions. We are delighted to have him present today. So join me in welcoming Peter Hafez. Thank you.
Thank you very much. So I'll just bring up my presentation and we can get started. Perfect. You should be able to see it now. So thank you again. One of the things that has been very interesting. So I've been with RavenPack for more than 16 years now, and we have basically been operating in the natural language processing space for finance ever since the company started. So it's been quite exciting to see how the space has evolved over those 20 plus years the company has been around. And it almost feels like that there's a sort of a second wave that came about in the markets now with the introduction of ChatGPT and so on, and all of these GPT type models. So where you move into more generative AI. And we can see that early days, NLP was mostly, at least in finance, for more quantitative hedge funds, quantitative asset managers, and so on. But with this new wave of generative AI and large language models, we are seeing an increased appetite within more sort of quantamental and fundamental investors. So one of the things that, having been in this space for so long, it does very much feel like a new revolution. Also, as a quant or as a data scientist, these large language models have really empowered completely new workflows. And it is something that we are seeing gaining significant interest across the industry. And especially you are seeing large language models, not just for chat, right, which is what most people have gotten exposure to, chat or search through ChatGPT or Perplexity or also big data, which is one of our our offering that is focused on finance. But we are also seeing very, very strong interest around building out internal workflows. And that's where you start to go into this space of agentic workflows, where you're trying to automate processes and try to emulate how financial analysts would work with data in order to come up with an interesting insights that they can make some decision making based on. And but one of the things that we have seen, of course, the financial space is sort of very diverse. You have your big banks and your very well-funded hedge funds, but there's obviously also a forest of companies that, especially in the discretionary space, where you have limited data science support. Some of these firms have started investing in data science because they do want to, or you have seen them becoming a little more data driven over the years, but they still have perhaps 1 or 2 people on the data science side that supports an entire organization. And the other challenge that some of these firms are seeing when they're trying to take advantage of new AI technology is that the data infrastructure is relatively limited, right? It's often very simple, and therefore it makes it very, very challenging for them to get started. And they would, have one or two data scientists that they've brought in, expecting them to revolutionize the organization, and then they'll disappear for a year or two because they have to deal with all the infrastructure issues. And that's where you get into often some disillusionment within the organization and saying, hey, now we brought in these quants or these data scientists. What are they doing? They're not adding any value to us. And that's really the space that we operate in, right? To try and say, how can we help these data scientists focus on solving actual use cases for the business and helping them basically get a big gold star early on, such that the organization can see some early value and start to allocate more resources in transforming the organization to become more data-driven. So as part of my presentation, I want to highlight some of the workflows that we are seeing that our clients are interested in. As mentioned, there are many different ways that you can approach these types of workflows, agentic workflows, and I'm going to focus primarily on what we like to call chain of thought, which is this emulation of how a human analyst thinks. But first of all, I want to highlight, so big data, we launched in September of last year, we launched bigdata.com, which is both an app, which is a research assistant, but it's also a flexible API or flexible API. Yeah. And the API is really the underlying retrieval system that empowers people to do these workflows on top. So it's a content store, so you don't have to think about onboarding, news content, earnings call transcripts, or filings, or whatever content you're interested in. It's an NLP infrastructure where we take advantage of our 20 years of experiences in this space. We also have both structured and vectorized data. So both, and that means that you can both access text data and you can also access more structured fundamental data that is available to you to query as part of the API. And finally, as I mentioned, it is a hybrid retrieval system. And what is it? What do I mean by that with hybrid? Well, one of the things that how you can access information as part of a retrieval system is very simplistically, you could do keyword search. So say, give me the documents that contain a particular keyword that I'm interested in. Keyword search can be quite powerful if you are able to define very specialized keywords that you care about. Then it can be an interesting way of retrieving relevant content for your particular use case. The other way that people also search and retrieve for content is using semantic search. So that's where you move into more of an embeddings-based approach, where you're turning text into numbers, into vectors. And you are doing a similarity search and saying, give me documents or texts with embeddings that are closely associated or close in distance to the embedding of my question, for instance. And then finally, and that's where the big data system really shines, is that you could also do analytics search. So that means that we have basically pre-processed all of the content. This is also where we have our 20 years of experience, where we are encoding our knowledge graph directly onto the data with entities, tracking, companies, people, places, organizations, and so on, concepts. We understand time ranges, there's sentiment data and all of that. And you can use that as part of the search. So what makes that powerful? Well, here's an example, right? So if you're interested in understanding what companies are currently applying liquid cooling technology in data centers, in order to get as relevant content, textual content to answer that question, you can take advantage of this hybrid search capability, hybrid retrieval capability. So first of all, you will say, well, I may be interested in only European companies. So I can do an analytical filter using the entity detection systems at RavenPack, saying only look at documents that mention European companies. Secondly, you can do a semantic search that says, hey, what are the documents that talk about using liquid cooling technology? And there's a lot of areas where you're using liquid cooling technology. So there will be a lot of use cases that will pop up as being relevant in your search. But if you also are able to use a keyword search, which you're doing here, you're saying, but I want data centers to be explicitly mentioned when I look for liquid cooling in a semantic search perspective. That allows you to really sort of focus on the things that you care about and get a much more relevant data set for you to work with. So I'll just do a quick run through of a use case where we have gone through what we like to call chain of thought, where you can see the power of a system like this and where we are seeing a lot of interest from the marketplace in trying to automate various workflows. So we are starting out with a simple question. And the simple question is, and this is where we take advantage of sort of what you would call RAG. And that basically means retrieval augmented generation. So it's an interaction between a retrieval system and a large language model. That's the generative AI part, that you see at the end of RAG. But we start out with a question where we say, what company applications are leading the AI megatrend? So we are saying, how do we know, how can we see what are the use cases that companies really care about, right? So we have this main theme of AI solution. It's a seed into the workflow. We also can emphasize the focus of the analyst to make it more relevant to what it is that we're trying to answer. And here we are saying, focus on the direct impact of AI solutions on companies, in particular the revenue generation and operational efficiency. And this is where you can have a system that takes this input and starts to build a step-by-step process, and it knows how to prompt in every single step to answer the questions necessary. So the first thing we do when we have this seed information is that we create a mind map. So we have a way of saying, asking a large language model, tell me even what the definition of AI solutions is. It's a very, very broad thing. So give me a taxonomy or a mind map around how I should think about this concept. So now we can take advantage of an LLM to say that's the megatrend AI solutions, but now it could be broken into themes and business segments. It's happening automatically in the background. And AI solutions can be machine learning, natural language processing, computer vision, and so on. It can go deeper, predictive maintenance, fraud detection, it could be chatbots, sentiment analysis, and so on. And what we also do is that we create a note summary as well. So we're taking advantage of a large language model as being really good at making things up. It's really good at creating synthetic data, right? So we are basically creating a little story for each of these notes. Give me 20 questions I could ask for each note. And now we retrieve content for that. And we are doing it just talking to transcripts, and we are only doing it over this time period. And that could be done in a rolling fashion, so you can keep up the analytics that helps you answer your question over time. What do people care about when it comes to AI solutions, and how does that evolve over time? And what we then do is that we're taking the retrieval system, the API of big data, and we're saying, now do a multi-threaded retrieval of all of this content, right? And not only do that, we also use a large language model. When you have retrieved for each of the nodes within the mind map, we then say, please verify that this is really about predictive maintenance. Please verify that this is really about implementation of chatbots or sentiment analysis and so on. And now we suddenly have a structured data set of zeros and ones, right? And saying yes, no, yes, no, yes, no. And now we can start to visualize it. So when we look across, let's say, the S&P 500 companies, and we're saying, what are the AI projects that companies are running and they are talking about on their earnings calls, we can get this visual. So this is actually not S&P, this is looking across the world. So 19% of companies are implementing chatbots. 18% of companies are looking at customer segmentation, 17% data entry automation, and so on. So you get an idea of the kinds of projects your competitors may even be working on. You could also split that up into industries. Are there some particular projects that certain industries are focusing on? If you look at utilities and energy, they tend to focus on predictive maintenance. Telecoms are building chatbots, and financial firms are doing chatbots, data entry automation, and fraud detection. And you can take it a step further, because you are actually analyzing individual earnings call transcripts. So we can go into individual companies and saying, what are they doing? And now we can start to move into, let's look at the financial materiality of these initiatives. And that's where you can start to ask, again, an LLM, if I want, and go through your mind map, if I'm focused on predictive maintenance for the aviation or airline industry, give me the key KPIs that I should care about. And now you could do another request to your retrieval system and saying, now give me things that talk about these KPIs, and then try to extract actual information from it. And this will be my last slide to cover the workflow. Here we basically show how you, for American Airlines, have identified a number of KPIs that are on the left side of the two tables. You can see there's mean time between failures, aircraft availability rate, maintenance cost per flight hour, and so on. And you can then see the extracted text that actually speaks about the KPI. And in some of these, the ones we have highlighted in green are the ones where you actually have a numerical, some metric that you are able to extract. And now that can feed into your valuation models of these companies, such that you can have a, rank your universe of companies in terms of which ones may be good buying or selling opportunities. So as you can see, it's possible just with that initial seed of AI megatrend and that analyst focus, you're able to do some pretty sophisticated stuff, taking advantage of big data, so content, taking advantage of NLP infrastructure, the retriever, and also very much utilizing large language models to help you sort of organize and verify the text that is being retrieved from your systems.
Thank you, Peter, for this insightful presentation. We can now move on to the next speaker for this session. Really doesn't need any introduction, as you've already seen him a few times during this experience. But let me give you a few points on his profile anyways. So the next speaker for this session is Professor George Skiadopoulos. He is a distinguished expert in finance. He is a professor at the University of Piraeus and Queen Mary University of London, and co-founder and director of IFFR. In addition, he is a member of the Consultative Working Group on Investor Trends and Research of ESMA, Risk Standing Committee. His research is impactful and focuses on the fields of asset management and asset pricing, climate finance and ESG, commodities and financial derivatives, with publication in leading journals. Please join me in welcoming Professor Skiadopoulos.
Thank you very much, Sandrine, for your very kind introduction. My presentation should not take more than 15 minutes, even less, so please feel free to interrupt me very rudely if I exceed my limit. So let me share my screen. Okay, I hope you can see that. So what I'm going to try to do in the next 15 or even less minutes is to provide an application of machine learning to the area of climate finance in the field of asset management, in particular, whether we can search for climate alpha by relying on machine learning techniques for the purposes of measuring climate change risks. So in order to earn this climate alpha, if any exists, the first thing we should be doing is to construct measures for climate change risks. And to this end, I'm going to show to you that machine learning methods may be a way to do that. So let me describe very briefly the general setting. So what is the idea here? We would like to construct an investment strategy based on a new risk measure. And in general, the concept of alpha is nothing but the average abnormal return. So by abnormal, we mean relative to the normal. And what is the normal average return? Well, this is given by a benchmark model, which typically excludes the new risk factor or the new risk measure we're exploring. So what is climate alpha? Well, climate alpha is the alpha that we are going to earn from a strategy constructed on climate change risks. Of course, the question is whether a climate alpha is expected to exist in the first place. And theoretically speaking, if climate change risks are not priced, meaning they are not reflected in, say, stock prices, actually, if they are priced, if they are reflected in stock prices, then a climate alpha exists, whereas if they are not priced, then the climate alpha will not exist. It's not clear in advance whether a climate alpha exists or not. On the one hand, there is the key question whether investors really care about climate change risks. Another issue is that the decarbonization of portfolios entails high transaction costs. And a more general question is whether decarbonization actually pays off at the end. On the other hand, it may be the case that climate change risks are measured, are priced, because investors may be sensitive to short-term effects, like, for instance, the effects of regulation. So what are the steps in searching for climate alpha? Then the very first step is that one needs to measure the climate change risks. Then you need to implement the climate strategy. And then you need to measure alpha. And to this end, you need to specify a proper benchmark model. What I'm going to show to you here is a case study, if you like, based on our recent research. It's very practical, as you will see, and it has attracted the interest of investors, firms, media, policymakers, and supervisors. One may be wondering, why is there need to resort to machine learning methods, or more generally to AI methods, for the purposes of measuring climate change risks? Well, because the measurement of these risks is really challenging, because climate change risks are multidimensional. So in general, we have two types of climate change risks: the so-called direct risks, which basically are the physical risks like hurricanes, rise of sea levels, and wildfires. And on the other hand, we have the so-called indirect climate change risks, like the transition risks, namely, which stem from government actions and the adoption of new technology. So the dissection is really crucial in search of climate alpha, because there is a heated debate about whether physical or transition risks are priced. So if you talk, for instance, to Christine Lagarde, then she will tell you that physical risks are not priced, and that's why there is need for government's intervention. On the other hand, if you speak to some leading asset managers, they may tell you that physical risks are not priced because investors do not simply consider them to be systemic types of risks. But if there is government intervention, then these transition risks by construction are going to be priced and are going to cause distortions. Now, how about existing measures of climate change risks? So, for instance, measures relying on the so-called hard information, like, for instance, E-ratings or carbon emissions. Well, these hard information measures are not always helpful, because they present typically an aggregate number, so E-ratings cannot dissect between physical and transition risks. They come at low frequencies, whereas for investment purposes, you may need a real-time measure. Recently, there is the issue of data mining, which has come up. So some ESG providers data mine their data in order to attract attention from investors. And then there is the issue of measurement errors, like, for instance, when it comes to measuring carbon emissions. We all know that the Scope 3 carbon emissions are far more difficult to be measured compared to Scope 1 and Scope 2. On the other hand, machine learning techniques can assist, as we will see, but there is a caveat here. Results may heavily depend on the method one employs, and of course on the input. So we need to be extra careful here, because garbage in means garbage out. So I'm going to show briefly some evidence from our quite recent research by Renato Faccini and Rustin Matain, where we provided first-time evidence on which types of market-wide climate risks are reflected in US stock prices. So in that study, we constructed real-time novel aggregate climate risk measures initially over the period 2000 to 2018. And now we have updated that up to 2023, and hopefully we'll update it even more. If you're interested in that, you can find these measures on our personal websites. The method we used is called latent Dirichlet allocation, LDA. It is a textual analysis, and it's quite intuitive. It works a bit like human brain. Whenever it comes to reading a big number of articles, what you are actually doing is, of course, it's impossible to memorize all that information, but typically what is happening is you try to dissect that information in topics, in categories that each article is talking about. So the output of LDA has to do with climate topics, and also it is giving us the intensity, if you like, that each article is speaking about each topic. So each measure is the attention that each topic receives by media on any given date. We started with about 4,000 climate-related Reuters articles out of 13 million articles, and we worked with that. And as you will see, the constructed measures can be used in risk management and asset management. Because of this practicality and because of the implications of our findings, this study has attracted a huge interest. So we have been invited and presented at the European Parliament, at the European supervisory agencies, at federal US banks, investors, at the Capital Markets Committee. The US SEC is mentioning this in its reports, likewise OECD and the Financial Stability Board. So what are the key findings of this study? Once we applied LDA to Reuters News, we managed to trace 4 important climate-related topics. The first one is the natural disasters topic. The second one is the global warming topic. The third one is international summits. And the fourth is the US climate policy. What we found is that climate policy alpha exists. We only get alpha from this measure here, from this topic, the US climate policy. And this alpha is quite recent in the sense that it is stemming post-2012. So the implications of this study using textual analysis and machine learning methods is that US investors do not care about natural disasters and global warming. They do not even care about international summits. What they care about is whenever the discussion reaches the political arena and the regulator intervenes. So just to get a feel about how this textual method works, basically, here we have the topics. So the bigger fonts words indicate that these words are discussed more frequently in the articles. So this is the natural disasters topic. So you see words like weather, heat, warm, disaster. The second topic is the global warming topic. So basically here we're talking about Celsius, heat, fossil. The third topic is the international summit. So you see here Japan, Kyoto, Copenhagen, so places where international summits took place. Surprisingly, Paris does not show here, and I'm going to say something on this very shortly. And then the last topic is what I call the US climate policy topic. So this is regulation and discussion in the US political arena at a state level like California. Here you see use legislation standards, and at a federal level, so you see here Clinton Republican campaign house. So how do these measures look like? So this is the natural disasters topic. So it spikes up whenever media focuses on natural disasters. Remember, the interpretation of these measures is the intensity that each topic is cited by media. This is the global warming topic. So this is basically information on scientific reports speaking about global warming. This is the international summits topic. So about here, we should be expecting to see the Paris meeting. but we do not. So what this picture says, which is constructed from media news, is that back then, Paris had not attracted much attention. When it was the case that Paris started attracting attention, that actually happened when Trump decided to withdraw for the first time US from the Paris Agreement. And that's how all this discussion about the Paris Agreement came up. And here is the US policy topic. So you see it spikes up whenever something is happening. So for instance, here is the point where Trump withdrew US from the Paris Agreement. And then you see, you know, various other events like the BP oil spill, Obama taking the presidency, and so on and so forth. If you want to see more on the interpretation of the US policy topic and the measure, basically these fluctuations mean the following. Whenever you see a decrease here, this means that transition risks decrease. So you see here that over for instance, the first Obama's administration, you have an increase in this measure, meaning that Obama was taking measures to combat climate change. Whereas in his second term, this is not the case. Why is that? Because Obama, over his second term, had initially lost control of the House of Representatives, and initially he lost control of the House of Senate, of the Senate. So he couldn't effectively pass any bills. Whereas here you see over Trump's first administration, this pronounced decline, which indicates that Trump actually was taking no measures to combat climate change. I still have 1 minute, I believe. Here, by using the climate change risk measures, what we have done is we constructed a standard long-short portfolio strategy by sorting stocks, US stocks, on each one of these 4 measures we have constructed, and we have estimated alpha using as a benchmark model, alternative specifications of the benchmark model. What you see here is the alpha. This is per month. And what you see here, the asterisks indicate that this alpha is statistically significant, as we say in the academic jargon, only for the US climate policy measure, meaning that the other 3 measures are not reflected in US stock prices. So I believe this is my last slide. Machine learning techniques can be used to measure climate change risks and search for climate alpha. However, the methods and inputs do matter. Climate alpha may exist only with respect to a certain dimension of climate change risks. And what are the possible explanations for that? Investors may have limited attention, so the political arena serves as a wake-up call. Investors may be lacking information about firms' exposure to physical risks, so this is where regulation and disclosure of climate risks kicks in. And or investors may be myopic, so they care only about short-term risks. And there is, of course, always the 4th possibility that investors may not consider physical risks to be systemic. So if you want to find out more about this, feel free to visit my site or even read the original study. So thank you very much for this. Thank you, Sandrine. Back to you.
Thank you, George, for sharing this insightful research on climate alpha. So we're coming up to the last speaker for this session. So I'm pleased to introduce Claudia Guagliano. So Claudia is head of unit at the European Securities and Market Authority. She leads the Consumer Sustainability and Innovation Analysis Unit in the Economics, Financial Stability and Risk Department. The unit is responsible for all ESMA analytical and risk work around digital finance, sustainable finance, and retail investors. She authored different publications in the area of financial markets, including on digital finance and sustainable finance topics. Thanks again, Claudia, for joining us. The floor is yours.
Thanks a lot for the introduction and also for the invitation to contribute to this session on artificial intelligence. I will focus my presentation on the use of AI in the European Union asset management. This is based on some publications that we had in the last years. And I will start by looking at some of the use cases that we see in asset management. And we see that there is a very diverse range of applications and potential use of artificial intelligence. Starting from the investment strategies, we have a number of different applications that have also a different level of intensity. They go from fully autonomous processes driven by predictive AI to areas where the strategies integrate AI models output just to inform the selection of the investments. It was mentioned already in some previous presentations. So, for instance, quant and hedge funds can use AI and, to be more precise, machine learning models for portfolio optimization and asset allocation, for instance, by estimating returns and also their variance-covariance structures. One main case that we use, one main use case that we observe is really the use of AI to support fundamental research and fundamental analysis. Indeed, AI can help really to address and to include, to assess different types of data, structured and unstructured, and to be able to include the information as quickly as possible in the investment decision. Many times, these AI models are building on natural language processing for text analysis of companies' disclosures, for instance, but also to analyze news, social media, and broker research and text in general. NLP is also a key tool in the area of ESG, in the ESG assessment, because it's very useful to measure the company's sustainability commitments, the climate risk exposures, but also the involvement in several sub-areas of ESGs. AI is also included, and I mentioned briefly already, to evaluate other unstructured and alternative data sources that that until a couple of years ago they would not be used at all. And these are data such as satellite and aerial imagery, sensor data, and potentially this can happen in real time. So, for instance, for commodity traders, it is possible to monitor almost in real time crude oil flows and storage, harvest, impact of extreme weather events. And also for the ESG investment, these models allow to monitor in a very efficient way pollution, deforestation, flaring activities, as well as the impact of natural disasters for insurers. Of course, these developments may be very beneficial for asset managers and also may bring a lot of advantages in terms of efficiency. At the same time, they also pose some risk. It's very important to highlight that many of these risks are not new. These are really risks that for all financial analysts are very well known since several years. And in particular, the vulnerability to algorithmic bias and data quality are not new. At the same time, this can be amplified by artificial intelligence systems that may become more complex or used easily on a large scales. And then there is the usual, the problem that is always mentioned of model explainability. When the AI model becomes particularly complex, like for instance, neural network, it's very difficult to understand where the results come from. And many times, if there is a mistake, to go back to the model and understand where the mistake comes from. When we focus on Gen AI, it has been said in the previous presentation that we've seen since the end of 2022 a new wave of interest in AI driven by the developments around Gen AI. Now, Gen AI can also amplify several risks that were already there with the digitalization, but this can be really amplified. Risks like operational risk, data protection, privacy risk, and also this can be amplified also by the fact that there are very low barriers to use and also direct use by consumers. One important risk related in particular to Gen AI is related to the concentration of AI providers, which increase the reliance on third-party providers. We have seen it already with the cloud service providers, and here we are seeing a very similar developments due to the high cost needed to develop some of these models. Now, looking a bit broadly to the market developments, there is, I said, a lot of interest in AI, but we see also booming valuations of AI companies, and this may lead to price bubbles, and also sometimes, from the investor perspective, to the lack of diversification. And it's also what we observe is also a bit of AI washing, in particular by the companies that are saying and marketing themselves as AI user in order to attract more and more funding. Now, from the supervisory and regulatory perspective, what we see is that there is a lot of interest, there is a lot of development activity around AI, but the use of AI so far is not yet disruptive, but for sure we need to monitor it closely. We have now in the European Union a legislation related to the AI Act, that is an horizontal regulation, so it doesn't apply only to finance, but to all the economic sectors. And one of the objectives is really to promote risk management and ensures that the tools are developed and used responsibly across different sectors. Now, we have done a bit of analysis to understand what is the use of AI in the asset management sectors. So we applied some AI models ourselves, in particular natural language processing, and to analyze 800,000 regulatory and marketing documents, key information documents, prospectuses, fact sheets that are issued by 44,000 funds between 2020 and 2024. So we applied some machine text mining to identify how many times the words AI, machine learning, and other related relevant terms like NLP, GenAI, LLM, etc. And then we also had some, let's say, manual work, human-led work, to try to screen all these documents and to minimize the number of false positive and false negative coming from these applications. Then we classified all the funds with some AI mentioned in their text in AI-driven, where really the investment strategy is primarily determined by AI, or more generic AI use. And here on the slide, you see some example. So in the first case, we define this fund as AI-driven because they were clearly saying that the fund was seeking to achieve long-term capital growth primarily through a proprietary quantitative stock scoring model that use artificial intelligence and use advanced techniques such as deep learning, thereby differing from conventional model or algorithm. So in this case, we thought that the AI, the artificial intelligence, was really at the core of the strategy of the fund. In the second and the third case, this was not the case. And so for us, these are funds using AI, but not really AI-driven, because, for instance, in the first case, they were stating that the investment manager use data analysis and machine learning techniques to help identify stocks that are expected to outperform. So it's more a preliminary use of the AI and not really the use of AI in the core business. So doing this, what we found is that in reality, the funds are not promoting the use of AI, because out of 44,000 funds, only 145 funds, so less than 0.3%, indicated using AI or machine learning in their investment strategies. In terms of asset under management, this is more or less 0.1%. And the number of funds saying that they were using AI peaked in 2023. Of these funds that were promoting some use of AI, only few of these adopted AI-driven strategies, as I defined a couple of minutes ago. And then we ask ourselves, why is this happening? There are probably several drivers, and this could be related to data and modeling challenges, operational risk, but also a bit to the so-called black box stigma, so that there is not too much trust yet related to AI, and to the fact that the investment strategy is based on AI. To be clear, the fact that I'm not saying that only 0.1% of the funds are using AI. What I'm saying is that 0.1% of funds are promoting the fact that are using AI. AI seems to be also based on market intelligence, seems to be very much used as a supporting tool. For instance, GenAI, NLP is used a lot, but is not promoted formally. And there is only one marketing document among all the 800,000 funds where there was mentioned the use of GenAI to enhance the stock screening and the analysis. Then this is happening also because there is not a lot of investor appetite. If you look at the second chart on the slide, you see that in terms of inflows and outflows of these funds, we see that the funds that use AI had limited success with really uneven investor flows and quite a lot of outflows in the last quarters. And then we looked at the cost and performance of these funds, because one question that you can ask is, okay, how are they performing, or are the costs of these funds higher, lower compared to the peers? What we see is that the performance is not significantly higher or lower than those of that of comparable actively managed funds. And also we checked for several controls, size, age, and geographical investment focus, and we didn't find any specific and significant difference. And a bit the same on the cost side. The fees are marginally lower for retail equity funds, but then for the others, but not in the full sample. So we don't see really statistically significant difference. So to conclude, what are the main takeaways of this analysis is we see a lot of interest. In particular, the interest increased a lot after 2022. We have that so-called traditional predictive AI is used by several fund managers, but it's very rarely is used for fully autonomous portfolio optimization. GenAI is used mostly for fundamental analysis and operational tasks, but so far has not been promoted formally. And so there is, for investment funds, no sign of widespread AI washing by investment funds based on the number and on the results that I showed a couple of minutes ago. And so the risk of hoarding behavior, procyclicality from the use of AI by investment funds appear low. But as I said, things are changing very quickly. And so we really continue to monitor the developments on these sectors. And let me highlight again that there is these broader issues of operational dependencies and cybersecurity vulnerability that may become more relevant. So let me stop here. Thanks.
Thank you. Thanks a lot, Claudia, for an insightful presentation as well. We do have one question for yourself, Claudia, and then I may move back to the other presenter. So the question that was addressed to you was the following. So is, why should asset management using AI be a concern for the regulator, supervisor? AI is indeed just a type of an internal model as any other internal model.
It's not the first time that this question has been asked, and indeed, I think what I show in the slides clearly highlights that there is no interest in promoting the fact that asset managers are using AI. Let's say that in our risk assessment, we generally try to assess and to analyze the different developments in the structural developments and also the market developments that may have some impact on the asset management risk, on the asset management strategies. In the last years, the main two areas where we have done analysis have been ESG, and we had the presentation earlier, so the interest of asset managers in ESG and investment in that area, and the other big structural developments is AI. AI is not relevant only for asset managers, of course. It's changing really the way that the economy is functioning and in general all the financial markets.
Thank you. Not sure we have time for another question. George, let me know if I have time.
Yes, we still have about 3 to 4 minutes.
Okay, so I think, Peter, there was one question for your attention. So if I may, the question would be, there are so many LLM models and AI methods out there. All of them read like a black box, and they may also overfit data, or even their output can just be noise. what should be the metric under which one should evaluate the quality of any method?
I think it is a tough question, of course. I think a lot of when you do modeling, you do have to have really, really good evaluation sets. And there has, of course, already been some challenges here because there was a recent paper and some recent discussions also on X that sort of looks at the access of these large language models providers and having access to the data of the benchmarks, right? So they are really good at delivering performance on the benchmark because the model has been trained on the benchmark data itself. So it's not really fully out of sample, a lot of it. So of course, the challenge becomes as a end user that you build your own benchmark data sets that of course can be somewhat heavy or expensive to create, but that you create some humanly curated benchmarks that you can evaluate up against to see if performance is as expected. But otherwise, it also comes down to what types of use cases or what types of things are you comfortable in solving with a large language model. And we have seen that large language models are really good at, of course, they're pretty good at summarization. They're pretty good at coming up with synthetic data. They're pretty good at also labeling, verifying content, extracting information, and so on. But you try to limit it to certain tasks that you are comfortable with. And especially in finance, I think it's important. If you look at some quants, they don't really like large language models because of the potential look-ahead bias, where discretionary users that don't really care as much about history, but more about what's happening going forward, they can take advantage of it. So you have to think about it very, very, very thoroughly, what your benchmark should be, and also the use cases that you apply it to.
Thank you. Yes, so thanks a lot, Peter, for your explanation. Maybe one last question for you, George. So you've been talking about climate alpha, and there was a question about it being very difficult and challenging to assess, but is it also the case? Have you done some research on ESG alpha overall, or what are your thoughts on that?
Yeah, that's the $1 million question. So indeed, the academic evidence on whether ESG alpha exists is very mixed, but what we have documented very recently in a paper published in the Accounting Review is that what it crucially matters is the choice of the benchmark model. So remember, alpha is about abnormal average performance. So when you are talking about abnormal, you need to define what you mean by normal. And the benchmark model matters a lot. So relating that to Peter's presentation, where he talked about financially material issues, what we have found is that if you dissect ESG ratings in material and immaterial ESG ratings, and you construct a materiality portfolio sorted on the material ESG ratings, then the material ESG alpha vanishes once you include in the benchmark model the profitability and the investment characteristics of the firm. So this goes against the narrative widely used previously that material ESG alpha exists, and which has promoted the development of various financial products by various institutions. So that's from me. Thank you.
Thanks a lot. Thanks a lot, Claudia, Peter, and George, for an insightful session. I'll hand it over to you, George, for the next session. Thank you.
Thank you very much, Sandrine, and thank you very much, Claudia and Peter, for joining.